What's your reading on this, Todd? Do you think this is a sign of higher inflation to come?
Well, I don't know. I think we're trading at a real inflation of over 10% anyways, okay? I think that the jobs...
Hey, where's that coming from, Todd? Back up here.
Look at prices. Look at the price of oil. You know, they when they come out with the CPI and they tell you excluding energy, well, again, at the end of the day, you know, energy may, at the pump, it may not be part of your inflation curve because it goes up and down, but it affects every business that you're in. So inflation is ridiculous right now. Look at the price of copper, copper, and look at the price of oil. I mean, oil is over doubled since the election. Copper is threatening to make, high highs here now. I mean, it's been down the last few days, but again, you look at all of the commodity spaces and they're booming higher, which means higher price to the consumer. And I think that we're seeing it and I think we're feeling it. So, I think when you look at inflation, it is real. And the Fed refuses to admit to the fact because, of course, we've got too much stimulus going on. We've got too much adding to the money supply. And you got too many people saying, no, I'm lazy. So the jobs number to me is natural here because we didn't work basically, in certain places for the last 12 months. So you're putting people back to work. So to see a rise, these kind of numbers is not unusual. Let's see if these numbers a year from now are going to measure up. And I would say they will not. Anytime you get a government number, it's ridiculous because they're not necessarily real and they will always adjust. So should it be hotter? I mean, based on ADP, it would be hotter, but again, they don't always work in sync together. And it's hard to grasp where they're going to be. Based on the jobless claims of recent vintage, I would suspect the number will be hotter than we think. But I don't know what kind of reaction we get from the street because we're seeing a continuation of a dramatic rally in equities, which, look, at the end of the day, we keep making new highs. So, to me, the markets are very comfortable. But of course, a lot of that's got to do with the cheap money. I'm really tired of this ridiculous stimulus. And I'm tired of people saying they make more money staying at home. Of course, those are not people you'd want to hire to your company anyways, because they're lazy to begin with. But at the end of the day, we've already had 26 states stop the benefits. Okay. And I think there's going to be more before it ends because you do have that problem. There is help wanted everywhere. And now, the employees are in control, okay, which is fine. Okay, listen, it's if salaries are like a price discovery market anyways. You need help and you want to pay more, you'll pay more. You'll pay what you need to get your help. So at the end of the day, I think that, that hopefully the stimulus will end because it's causing a lot of havoc in the rest of the economy.
Well, maybe people aren't lazy. Maybe they just got laid off and they're looking for another job. This is interesting.
I'm talking about the people that could get jobs. There's plenty of jobs out there. And I'm not talking about someone who's a tradesperson or whatever. I'm talking about people that work for the lower wages and that they get, if they would work, they would make $1,400. If they stay home, they get $1,500. That to me is a backwards model, which shows you, in my opinion, the ignorance of government for continuing to feed the stimulus when we need these people to go back to work. And I think what's going to happen is these workers are going to get replaced by illegals like it used to be. And then when they need jobs and there is no more stimulus, then where are they going to go?
The number of people quitting their jobs is up. I wonder why that is. Do you have any theories as to why that might have happened?
Oh, yeah, that's an easy one. Look, there's a lot of companies that need help and they're willing to pay more. So if you can improve your salary or improve your hourly wage by quitting and going somewhere else, why wouldn't you? The employment field has become very competitive. Opposite of the 2008-9 when we were overemployed. Now we're underemployed. So employers are willing to step up and pay more. I saw a sign yesterday that a place was willing to offer a $500 signing bonus if you came to work for them. So you can see the demand for help is way up, okay? And people can get better wages than they could ever get through real minimum wage because companies are paying more than a minimum wage because they need to get help. They need bodies to work and they need people to fulfill.
What are the biggest economic problems that an investor needs to address right now?
The capitalist versus the socialist environment. And of course, the extremely uber wealthy don't mind the socialism environment because they can continue to capitalize either way because they got the money. And I don't think you've seen the average investor, although their 401k has gone up, and we can argue whether it's up because the money supply keeps getting added or if it's real gains. But I think we're setting up for a very nasty correction at some point. And I wouldn't be surprised to see that correction as big or bigger than 2008-9. it's natural to the market, and the way that they have fed and artificially pushed this market up, to me, could create a much bigger problem down the road. But in the meantime, we're still long, and I'm not doing anything until it changes. When the market decides it's ready to go down, and there are a lot of signs now that are sending warnings, but we don't pay attention because, of course, we get very complacent when the markets are going our way, and we forget the basics of being protected just in case. Now, again, I'm not predicting anything. I don't know when the markets go down. I will guarantee it goes down, and I would bet, okay, that it would go down before they make two rate hikes. I think we're going to watch.
Okay.
If the bond traders push and they can get the 10-year over 2%, I think you'd see an immediate meltdown there, because there are too many people in the markets right now that would prefer to be in fixed income and not in equities. Basically, the Federal Reserve is way out of their box of what they're supposed to be doing. Yes, it's supposed to be full employment, but they're going to create either hyperinflation or stagflation here, very much like the Jimmy Carter era. Okay. Right. And I think what will happen is that we will start to see reasons for selling, and pressure will start to get, there's a lot of weak hands that are holding equities. So, when you look at it, okay, and you understand it like that, again, I'm not predicting it today or tomorrow, but, the rate hikes will come. And I think what will happen is the Fed is testing, and they went from transitory inflation to temporary. The next step is real inflation, and we'll see how the markets react and how they react. But certainly the demand for money is huge. Just look at the housing markets, and they certainly could go up. Rates should be higher just on natural price discovery, which is suppressed by the government and the Federal Reserve.
So the next correction should be greater than the one from 2008. What do we do then? What do we do? I mean, as an investor, do we go to the bond market? You told me you're short gold and silver. Equities, weak hands in equities, like you said. Where do we go?
Well, I mean, you can either use derivatives to hedge your overall portfolio. One thing I can tell you for sure, David, is I do teach a hedging program, but if you just stay in the market, okay, again, you can't time the market. It's time in the market. And if you just stay in and do nothing, the market is still proven in its history to go up 8 to 8.5% year over year, as long as you're investing in good companies. Now, if you're over leveraging, you're playing crap, well, then you figure to lose all your money. But if you place, if you buy apples and, it's a good solid companies that you assume will be in business 20 years from now, those are going to come back, and they're going to suffer, and they're going to come back. And that's where the key part of leveraging yourself and not over leveraging to the market, so that you don't get that fear of panic and putting in money that you can afford, knowing that basically on average it grows 8.5% per year. Nobody's doing anything now because they're all complacent, knowing the markets can only go higher. And then when the panic starts, okay, they'll all jump and try to buy puts at the same time, which will overinflate the price of put options, which is the protection to the downside, and they'll overpay for those. So not only will they lose on their equities, they'll lose on their put position as well. I am 100% hedged, and I know my risk to the exact dollar amount right now. Okay, so I will never sell, but I will get short the market based on the price action. I don't need all this information that is out there that everybody else is watching. I can watch price, and that will tell me when it's time to get long or short. And in this case, it would be short. Now, right now, again, as I said, full disclosure, we're long all the equity futures right now. Okay. And, and we're short gold and silver. So at the end of the day, when the price action starts to change, we will start to reverse, and I will stay in a position. I mean, in 2019, we were long the NASDAQ for 48 out of 52 weeks. So again, I can't tell you when. I tell you that the information that you're talking about is not really that valuable, because what you're trying to do is formulate an opinion, and all I'm trying to do is follow the price and follow where the money is taking me. Because I think if you follow the money, you have a much higher success rate.
So are there signals or signs that you would see that would flash a warning signal for you?
It's just price action, David, honestly. I mean, again, I'd like to make it something sexy and fancy. But if you watch the chart, if you use the phases of the market, which is, the market basically trades in 3 basic phases: consolidation, breakout, and blowout. So if you just follow that in the right direction and not get your opinion involved based on what you're hearing in the news or reading in a newspaper, I think you have a much higher chance of success.